Welcome back to my educational videos on the mortgage fund industry. My name is Brock Vandenberg, and I am the president of Talamar Financial and fund manager of Talamar Income Fund 1. In today's episode, we're going to discuss the lockup period in a mortgage fund. Whether you're a seasoned investor or just getting started, understanding this term is essential for making an informed investment decision. So let's go ahead and dive right in. To begin with, let's define what is a lockup period in the context of a mortgage fund. The lockup period is a predetermined amount of time during which investors cannot withdraw their capital from a mortgage fund. The primary purpose of a lockup period is to ensure stability and liquidity within the fund. It's a commitment period where investors agree not to pull out their investment prematurely, allowing the fund manager to execute their investment strategy effectively. So how long is a lockup period typically? Lockup periods can vary widely depending upon the fund's structure, but they often range from 1 to 5 years. It's essential to thoroughly review the fund's offering documents to understand the specific lockup period for any investment you're considering. You can typically find information on the lockup period within the Private Placement Memorandum, or PPM. You should always ask the fund manager about the lockup period and their general expectations. Now, you might be wondering why investors may agree to these restrictions. Well, there are some significant benefits. The first is stability. A lockup period allows or helps stabilize the fund by discouraging frequent withdrawals that could disrupt the investment strategy. As a fund manager, I can attest to this. It's really difficult to manage a fund efficiently if an investor is constantly adding and withdrawing funds. One of the most difficult parts of running a mortgage fund is forward planning to ensure that the amount of available capital is balanced with the loan volume. When you have frequent and irregular withdrawals, the forward planning can get very complicated. Second, aligning interests. One of the biggest advantages of investing in a mortgage fund is to earn consistent monthly income over the long term. The lockup period helps to ensure this and dissuade investors from using the mortgage fund as a high-interest checking account. Third, tax efficiency. Depending upon the type of fund you're investing in, the lockup periods can offer tax advantages by deferring capital gains taxes until the investor exits the fund. These benefits can be especially valuable in the world of mortgage funds, where long-term investments are common. However, it is important that an investor understands what they are committing to when investing in a fund with a lockup period. Lockup periods come with their own set of considerations and risks. Those risks may include liquidity risk. Investors may need to access those funds during emergencies or unforeseen financial needs. Now, most funds allow for withdrawals during a lockup period, even during an emergency, but there will most likely be an early withdrawal fee, and it may take some time for the fund manager to distribute those funds back to you. Second, market risk. Economic conditions can change over time, and the investment landscape may evolve during the lockup period. If you're uncertain about the strategy of the fund manager and the market adjusts during that lockup period, you may need to wait it out. Third, the fund performance. It's crucial to thoroughly assess the fund's track record and strategy before committing to a lockup period. I always tell investors, can I sleep at night if I invest? If you can't sleep at night because you're uncomfortable with the investment, it's probably best that you pass on that opportunity. Before you invest in a mortgage fund or any fund with a lockup period, make sure to consider these risks and consult a financial advisor. Just a quick review, a lockup period in a mortgage fund is a commitment period during which investors agree not to withdraw their capital. While it offers stability and benefits, it also comes with its own set of considerations and risks. Before you invest, always do your homework, read the offering documents, and consult with a financial professional to ensure that a mortgage fund with a lockup period aligns with your financial goals and risk tolerance. Thank you for joining me on this episode. If you found this information helpful, please don't forget to like it, subscribe, and hit that notification bell for more content. And don't forget to check out some of my other videos. Thanks for listening.